Yeah.
We don't like the
half,
5.
right? Yeah.
We want the 1. We want the 2 or 1, but not 5.
And that's really the main reason that we started our business to begin with.
Talk to me a little bit more about that. Tax saving secrets that the rich don't want you to know. In my own career, as I make more and more money, I find that my accountant, the accountant that I had before, was simply not enough or not sufficient enough to give me specific tax advice. And that's how I met Kyle. And Kyle comes into my business and look at what I have and helps me with my tax planning, my financial planning, and also my life insurance and a lot of different strategies that I wasn't aware of because I just didn't know.
I didn't know. How could I have known?
I've spent so much time focusing on my business. So today we're going to teach you a tax saving framework, a tax saving triangle, and give you some steps of what you need to do if you are a Canadian citizen. Some of these strategies, you'll find it, I think, will blow you away because it blew me away when I first learned about them. What are some things that you can do to actually minimize the taxes that you pay? So Kyle, I'm excited, so share with us.
Yeah, so this time we're really going to go comprehensive and we're going to talk about the whole thing and put the whole thing together.
Yes. So what is the first step?
So first step is everybody in Canada should start a business. From a tax perspective, starting a business is probably immediately the best thing that you can do, and from a long-term perspective in terms of setting a foundation for the rest of your tax plan, the best thing that you can do.
That's the very first step. That's the kind of the foundation of the triangle, right?
Exactly.
Got it,
Yeah.
got it.
So when we're looking at this pyramid, really a business is going to be the base of any pyramid that we put together.
And what's the difference in terms of tax percentage, tax rate, employee compared to someone who has a business?
Well, the key when you start a business, I might give you a little bit of a story here. So there's Peter, and Peter is a computer programmer. He's really good at what he does. So he's working at a local computer company as an employee. So all the money that he's getting,
You could
as
be
an
making
employee-
6-figure too, right?
Yeah, he'd be making even 7 figures potentially, right? If he's really good. So Peter, as an employee, will pay 53.5% tax.
Ouch.
Yes. So, and there's not a lot that he can do about it.
There's nothing you can do.
Yeah.
Actually, there's nothing you can do.
Maybe $20,000 a year he could put into an RSP.
Yeah.
But that really does nothing for him, right?
Yes. And what would be the difference? What would happen if he actually has his business?
So as a business, so Peter reconfigures things a little bit, and maybe even Peter becomes a consultant instead of becoming an employee.
Yes, kind of like an independent contractor. Right?
Exactly. So now he's an independent contractor, and he's contracted with the business. So there's some rules that go along with that that he'll have to follow, but we'll just assume that Peter's following those rules.
Okay.
So now Peter can take deductions. So he's a business now, he's got business deductions. So all the things that he was doing to support his business already.
The computer,
Exactly.
all those things, right?
Yeah,
He
his
could
cell
be
phone.
sometimes traveling, meeting with clients, perhaps,
Exactly.
right? So all those things could be tax deductibles.
Exactly.
Got it.
So now Peter's got a lot of tax deductions that he can add to or subtract from his income.
So thinking about even your employee, changing the nature of what you do, becoming an independent contractor, which now is the trend anyway. We're switching to more from the job economy to the skill economy. More independent contractors, more remote workers, right? Sometimes I think when you talk to the employers, you will be surprised that they actually quite like the idea because then they don't have to worry about the benefits and all those things. Those are yours to take care of, right? So you'll be shocked. So starting that business, regardless,
Yes.
thinking about changing the nature of what you do, that's the very first step.
Exactly.
To take advantage, okay? What's the second step?
So step number 2, we want to look at starting a corporation.
Okay, so not sole proprietorship.
Exactly.
Yes?
So we start as a sole proprietor. Yeah, sure, that's a good foundation for
Yeah.
what we're going to do.
Yeah.
But really the target is to become that corporation. And that's really the main reason that we started our business to begin with.
Yes. And it's not hard to start a corporation. You can find an accountant to do some paperwork. It doesn't cost a couple grand. It's nothing, right? Compared to the savings that you get, right? And what is the difference between corporation and just sole proprietorship?
So the main difference that we're going to experience, so again, Peter was an employee and he was paying 53.5% tax.
Yes.
As a corporation, even though he's got deductions, he'll still pay that 53.5% tax
After
rate.
the deductibles.
Exactly.
Yes.
After the deductibles. But now that he's a corporation, his top tax rate is going to be 27%.
That's more like it.
Yeah.
Yes. Right. So then it's worth the investment of just getting someone to do the paperwork, an accountant. You can even do it yourself. I say go with an accountant, it's easier. But you can even do it yourself, just set up a corporation, right? And every year, how much it costs to maintain a company?
Well, there's a few different expenses that you might have. It will be less than $2,000 probably.
Yeah, from the tax saving perspective, it's nothing.
Exactly.
Right, it's nothing. Got it. So start the business, even sole proprietorship is fine. Next step, actually incorporate.
Yeah, and there's
Got it.
more too. So number one, you get the 27% rate. Number two, if you're a small business and you're likely to start out a small business, you'll get the small business deduction. So the rate that we'll actually pay on our income under $500,000 will be 11%.
Thank you, God!
Yeah.
It's looking better. 50 somewhat to now. Okay, that's looking better, yes.
So what we've managed to do is reduce our income originally by taking all those deductions.
And we're talking about you making the same amount of money. So in this case, Peter's making the same amount of money, but changing the nature of what he does, he saves a whole lot of money, right, as a company.
Exactly. So we've reduced it already using the business deductions. And now because he's a corporation, we've reduced it again to the corporate rate.
Yes.
And now because he's a small business, we've reduced it again. So Peter's tax rate has gone all the way from 53.5 all the way down to 11%.
Without changing the work that he's doing. He's doing the same computer work, same programming work, whatever that he might be doing, and computer engineer, whatever he was doing before, it's the same. But just knowing some of these vehicles, do you see? Comment below the difference this makes if you're a Canadian citizen, right? Okay, and then what's the next step?
So now we've got that 11%. So
Yes.
Peter's now paying 11%
Peter's happy.
on the money that comes
Peter's
in.
happy.
Yeah.
Yes.
So that's our golden 11%. We
Yes.
want to hold on to that however we can, right?
Yes, yes.
So the rest of what we do is going to be preserving that 11%.
Got it, okay. Okay, so what will be the next step?
So our next step will be to create the proper corporate structure.
Okay.
So again, if Peter has a corporation and he pays all that money out to himself, he's going to have to pay 53.5%
Yes, the highest income bracket.
again, right? Exactly. So we want to find a way that he can pay that money out to somewhere that he can use it without paying that 53.5%.
So then we're talking about a holding company
Exactly.
as well as an operating company.
Exactly.
So a holding company, a whole code, as well as an operating.
Yes.
Right? So then you can flow the money through.
Right. So we're going to flow the money from the operating company to the holding company
Yes.
as an intercorporate dividend. So that's a dividend that we're not going to have to pay tax on.
So flowing money from one corporation to another corporation. So in this case, you have two entities, in other words, right? And what are some of the other advantages besides tax to have a whole co or operating?
Well, the nice thing about a holdco, there's a few different things that are nice about a holdco other than tax. Number one is maybe Peter's going to build this company into something substantial in the future, his operating company.
Yeah.
He might want to sell it at that time.
Okay.
So he might want to separate the investment assets that he's got in his holdco from the business assets that he's got in his operating company.
Got it. So he has the holdco, he has his little business that's got going, the operating company. So in the future, he might have a bunch of other little mini Peters, like little programmers, right? That he has, that he might want to do something else, or he might want to get into software. We don't know. right?
Exactly.
Besides programming. But now he has the way that they can do that. You have flow through the money to be able to invest in different things.
Yes, so he manages to give himself a lot of flexibility.
That's right.
The other thing he could do, again, this may be getting ahead of ourselves a little bit, but he could do an estate freeze, freeze the shares of that holding corporation, and allocate shares to his family.
Yes, that's more for estate planning. And we've made other videos on how to do that. You could click here and then you can check those videos out. So step number 3, company structure. And step number 4?
So step number 4, so now we have another thing that we have to avoid. There's all these things that we need to avoid when we're doing our tax
It's like
planning.
a tax, what is it? Landmine.
Yeah.
We want to
Like a
we want to
landmine.
avoid stepping on those.
Yes.
Yes.
So landmine number 1 is now behind us.
Yes.
That's the 53.5%,
That's
right?
the biggest one. That's a big, massive one right there. Yes.
But we do have landmine number 2,
Yes.
and that is the passive income tax rate for a corporation is 50.67%.
The 5 just like,
Yeah.
okay.
Yeah.
We
Anytime
don't
it's
like
over
the
half,
5.
right? Yeah.
We want the 1. We want the 2 or 1, but
Yeah.
not 5. Yes.
So what we have to figure out now is, now in our holding company, we're making a lot of investments.
Yes.
And we don't want to pay 50.67% if we can help it on those investments.
And how do we do that?
So in our holding company, we'll want to put a tax shelter.
So step number 4 is a tax shelter kind of
Yes,
structure.
exactly.
Well, talk to me a little bit more about that.
So essentially, the simplest tax shelter that you can put in your holding corporation is what we call a high cash value insurance plan.
Okay.
So because it's insurance, it's not really an investment, but we can stuff a lot of money in there so that it acts similar to an investment.
Can you give me an example?
Yeah, so a common plan might be something that we call a capital pool.
Okay.
So we're going to put, say, $250,000 into this capital pool. So we'll have our operating company do an intercorporate dividend of $250,000 into our holding company.
Holding company, yeah.
Then we'll put that $250,000 and we'll fund the first year of that high cash value insurance plan.
Yes.
So within 10 years, we'll say, we put in a total of $2.5 million.
Yeah, because it's $250K a year for 10 years, right? 2.5 million 10 years.
Yeah.
Just so you're clear.
And it'll be worth, say, $3 million at that point.
Yes. Why is it worth 3 million?
Because it's growing tax-free.
Correct.
Exactly.
Right. You're letting your money work for you, right? Yeah.
So that'll be the key to get some money into a tax shelter so that we don't have to pay that 50.6.
And it works because you have the whole co and then you have the operating company.
Yeah.
Right? So tax shelter. You see, it's very different than just as an employee, you get tax from the government. It's like, hey, or you buy a little bit of RSP, which is pathetic, quite frankly.
Pathetic.
Right? It doesn't really do anything if you're a high income individual. So step 4 is that corporate tax shelter.
Yeah.
Right? Got it? And then step 5?
Yeah, and the important part is we've still managed to maintain that 11%. We
Yes.
still haven't moved from that. So step number 5 is leveraging.
Okay.
So now we have our holding company.
Yeah.
And we've got our tax shelter inside.
Nice.
Now we want to start using that money for different things.
Okay.
So-
Give an example.
Yeah, so say we're 10 years in, say we've now got $3 million sitting there in our tax shelter.
Okay.
And we want to start another company. It's Peter again. Peter has an opportunity to start that software company.
Maybe he's been in the industry long enough, he sees a problem. Hey, you know what? Maybe I could build a software instead of providing a service to solve that particular problem, but it's going to cost a little bit of money, right?
Exactly.
So he could leverage that 3 million that he has to do that, right?
Exactly. So he'll borrow the $3 million out.
Yeah.
And he'll
he
now
would
use that for
would he
business.
start another operating company probably? Perhaps.
Likely.
Yeah.
Likely.
To flow through that? Got it. So that's leveraging the money you saved in the tax shelter to do something else.
Exactly.
Got it.
And the nice thing about leverage is that now we've got an interest expense. So we can start taking deductions inside the corporation now. So maybe we used it to start a new company. Maybe we started to do some passive investments. If we did it for the passive investments, now we've got deductions.
When you say passive investments, give us some examples.
Oh, sorry. It might be maybe you buy bonds within the corporation, maybe stocks, something like that.
Yeah,
Maybe
something
some
that
private
you're not
equity.
actively operating in, just as passive investments.
Exactly.
Just so we're clear.
So
Awesome.
those would be taxed at 50.67%.
Correct.
So now we have deductions to offset that.
The deduction comes from where?
The deduction comes from the interest that we have to pay on the loan.
Got it. So you see how this kind of flows through, right? You might want to watch this one more time because we're going through a lot of things in a short period of time. And then what is next step number 6?
So our step number 6 will be to get some kind of capital dividends.
Okay. And how does that work?
So what we'll want to do is we'll want to use capital gains investments.
Okay.
So capital gains investments might be something like stocks.
Okay.
Some private equity
Okay.
might fall into that
Okay.
category. Maybe you buy a building.
Some form of real estate.
Exactly, some kind of real estate. So the reason we want to do that is that when we actually sell these assets, remember we talked a little bit while ago about the fact that half of it will be non-taxable and the other half of it will be taxable. So that 50% that's non-taxable, we can pull out of the corporation tax-free. So essentially at this point, what we're able to do, we're able to make the money in the corporation at 11% and protect it all along the way, and then pull it out tax-free to ourselves.
Yes.
If we have ideally set up the whole structure.
And we have to set it up properly in the beginning as well, right? So throughout these steps, right, it's almost kind of baby steps, right?
Yeah.
And it builds on one to the next. You cannot skip a step. It's one building on to the next step. And then what's the final step?
And then the final step will be your estate planning.
Yes.
So in the end, something is going to happen to your corporation.
Yeah.
Something's going to happen to you.
Yeah.
So in the end, you're going to have to sell your corporation. So you're going to have to get the right tax planning in place to make sure that we don't pay double taxation. Because everything that we've done up to this point, if we don't do anything else, it's going to lead to double taxation when we die.
And what would that look like?
So that looks like a total of 75% tax, which is 25% that you pay for the capital gains on the business, and another 50% that you pay for the dividends coming out of the business.
75%. So the government would take 75%.
Yeah, they're always waiting somewhere at the end.
They're waiting, they're watching.
Yeah, but there are specific tax plans that we can put in place to make sure that that doesn't happen.
And if this sounds overwhelming, it feels like it's a little bit confusing, that's okay. When I first learned about some of these tax saving strategies, I find it confusing as well, but Kyle was very, very patient to help me to execute on a lot of these things, and he is my personal advisor. So if you are a Canadian resident, and if you make more than $500,000 a year or have a net worth of more than $2 million, and you are a business owner and you want some advice on how to structure some of these things and how to minimize your tax, feel free to go to microfamilyoffice.ca and set up a time with Kyle and his team, and they'll be more than happy to help you. Regardless if you do business with them or not, you'll get some very valuable advice from them. So go to microfamilyoffice.ca.